So, listen, I wanted to call you. We hadn't talked probably on camera for a bit, and just give you kind of my impression as we close 2011 at a neutral stance from where we opened. And the
like almost flat. Yeah.
Yeah. I mean, I think we were within nickels, 1257 something and 1257 something. After trading down to the 1040s and up to the 1370s, so right back in the middle. I said to you before we came on that I don't know how to explain it fundamentally, technically, quantitatively, but I got an eerie feeling that I've never had in my 20 years in this business. I don't know if it's good or bad. I don't have any clear direction.
I've been talking to a few people, and I'm not sure I'm going to bet on the end of the world scenario, or that'd be a real bitch. There's a lot of things I need to do if it's going to be the end of the world, but it's never been a good bet before, so I'm not going to waste too much time on that. But as far as the eerie feeling, it's always such a stupid thing to say it's different this time. Like I think in Proverbs or Ecclesiastes in the Bible, they say, there's nothing new under the sun. And honestly, to a certain degree, I've been kind of compiling a list, and I actually have some charts. Now that I have all this new equipment, I might be able to splice it in and send the video back to you.
Yep.
There's a list that I've kind of compiled that it is different this time. And when Clinton was in office, we had that budget surplus, if you remember. Now, I'm not sure that wasn't some crafty bookkeeping, but it was a surplus. I mean, we supposedly were running to the good. And now we have, $15 trillion in debt. And I'll slice in a picture, like here, that shows what a trillion is for the people that have not seen this visual. So 15 trillion in debt, and that doesn't include, money that the betting that's done on the betting, all the derivative markets. I mean, derivatives are great. I mean, you got futures and options are a risk transfer tool. Derivatives are a great product to a certain degree, unless you're doing some of these credit default swaps and some of these other things, I think, make long-term capital's fragility, where a little Russian collapse causes a breakdown of the system, seem very small. So I think the size of it all maybe is creeping you out. I think what's troubling is because of the size of the bets got so big, and then you've got more idiots, more variables mixed into, I remember we used to have the G7, right?
Right.
Now we got the G20. Is it going to be the G35 next year? Fuck if I could tell you, right?
Right.
Besides that, you're in a situation where, I've had this argument. I just did a video recently saying that people don't make money in stocks, and they're trying to justify it. People come in and say, oh, no, but the long term. Well, the long term is different this time than it was last time. The last decade has been shit. And, they want to argue with me that stocks beat bonds. The problem is the asset classes. I'll produce another chart that I have these charts together. It's apropos that you call it perfect timing. That, you see gold and bonds and stocks just generally move up together. All the asset classes become linked.
Absolutely. Here's the thing that I see that, again, 20 years is not exactly a huge statistical.
There used to be a place to run and hide, right? Like, stocks are going bad, you went to bonds. Bonds are going bad, you had a place to run.
Right. The traditional, things, the correlations are, like, as you said, Greg, to me, everything is one. I mean, there is no hiding. There is no hedging. It's all one.
Everything's one cumulative asset class. If you're sitting there in gold thinking you're getting rich in 2008, when the wheels are coming off, people are liquidating gold to raise money because they're panicking about what's happening, and basically all the models turn to bullshit.
Right.
And what's different this time? There's no brake shoes left on the fucking car.
Yeah.
You're in a situation where you put people in a zero interest rate environment with this top-heavy demographic that I never shut up about. I guess people got to get bored of hearing me talk about baby boomers, but the point of the matter is you got 80 million people that aren't coming back to the party. No. If you're having a party and you have your hardcore friends that are the hardcore partiers, and they all get taken off by the cops and they're gone, they're not coming back to the party. I mean, the baby boomers are not coming back to pump up real estate. I don't care if you take long-term interest rates, even if the banks started lending money.
Right.
You take long-term interest rates and give 50-year loans, fuck you. Real estate.
No, and so going back to your original theme, Greg, I agree with you. This is
packaged with the fractional reserve banking. I mean, these things didn't exist back when stocks were good investments, were they?
No.
And stocks dividends used to be huge. Stocks used to yield more than bonds up until like 1952. Don't hold me exactly to the day, but
right.
What I'm saying is you used to get compensated for the additional risk. Now the most crowded space is the Johnson & Johnson, the big dividend stocks you get on TV, and you got these people saying, oh, you just need your dividends now. Everybody's a yield chaser. More money's been lost chasing yield than any other fucking thing on the planet.
Yeah.
And these people, I mean, I guess that's it. It's just the sheer linked size of this thing is just a disaster. And, I don't know how the story pans the rest of the way. It's like, it's truly different this time. It's never been this fucking hard. I mean, that's what's probably bothering you is you wake up in the morning, you come in, and the opportunities. I have this knife I was opening the mail. I mean, it just becomes wafer thin, just thinner and thinner and thinner in terms of, I find deals. The beauty is wherever there's a crisis or wherever there's a problem, there's also, a bright spot. There is this interest rate play, or there is certain correlations that are fun in games. There's things to do, granted, but they're a little complicated.
It's exhausting because...
Well, no, then you got to log in hours because you're sitting there chipping around these little tiny games. It's really difficult. I mean, look, last year the big asset classes that won were the meats. Okay, bonds did well, and pork bellies and fucking feeder cattle or something. Now the big losers were the softs. I mean, you had a nice go in coffee on the short. I wish I had my account teed up, but I wouldn't have stayed in long enough. I'd screw that up. Say, look, I want to own some oats, or I want to own some cocoa, and if it goes against me, I'll buy more because we're going to use. I mean, I think people are going to have some fucking Quaker State, whatever that's oil, or Quaker oatmeal, and I think people are going to have a fucking chocolate bar. I mean, I think people use these things. I think I'm going to eat some chocolate later. So, I'm very comfortable out of business.
And I'm with you. You talk about the winners and losers. I mean, isn't it interesting that natural gas just continues to get hammered all year? It was the big loser, probably 60-70%. And I think you could probably buy that and maybe short oil against it. But again, it's so weird that those two aren't even correlated together anymore.
What about that crack trade? Didn't that carry a bunch of people out in a stretcher? So there's a situation where what used to be a reliable correlation has become, if it's not different this time, it's going to remain this new normal, lack of normal for a very long time to digest.
So I agree with you. So the new normal is
years and years to go of this digestion of this debt pool, I guess. I mean, I think it all boils down to debt. It's just there's too many dollars. I don't know how to teach them to do it. So.
All right, Greg. We'll be back. Again, we're going to do more of these in 2012 just to have these ethereal talks and get on with it. But Happy New Year, my friend.